course, we saw that greater than expected rate hike from the ECB, something that you in your recent notes even said would go against recent communications. Is forward guidance dead now, and what would that mean for the markets?
It's a good question. Clearly, central banks are saying one thing and doing another thing. And we heard from some time for the ECB that a 25 basis points was most likely, and markets had pretty much expected that. And suddenly we had these leaks and then 50 basis points. So I think you're right. Forward guidance has become a little bit more unpredictable, or not necessarily useless, but it's not giving us that guidance as we would have expected. Central banks are clearly hiking more aggressively across the board, and it's not just the ECB. We've had a spate of upward surprises on rates from central banks globally, both in developed and in emerging markets. And it's really playing catch up here to rising inflation. And what's happening here is that growth is kind of being put on the back seat. Economic activity is clearly weakening globally, but inflation is the clear focus for central banks. And I think that's going to continue to mean rates moving significantly higher. That said, ECB and other central banks have been front-loading, and I think it means less need for more aggressive hikes thereafter.
What does this mean, though, for Europe itself when you have so much turmoil in Italy right now with Mario Draghi stepping down, the risk backdrop, and that anti-fragmentation tool at the same time?
Right, it's a difficult one. Unlike the US, where there's still consumer balance sheets are still pretty healthy, Europe is struggling with weak demand. So you have the energy crisis that's unfolding. Clearly, the Ukraine war that's still ongoing on the border. You've got other pressures clearly that on growth that are continuing across the board. So the ECB is in a difficult situation here, but they have now really said that they want to focus on inflation. When you've got inflation 4 times the target, there's no other choice here. So the ECB has to act, even if it means weaker growth. And so unfortunately, it means a mild recession or more in Europe in the next several months. But it also means ECB has to keep on hiking rates. So we could see another 50 basis points at the next meeting, followed by 25 basis point hike thereafter, until we get to a neutral rate of around 1.5% from the ECB.
Mitul, when it comes to the dollar, which of course is such a big driver for what happens with a lot of other currency pairs, we've seen a bit of softening over the past few days from the greenback. We heard from the BOJ saying essentially this is largely a dollar problem, not necessarily just a yen weakness problem. So does this kind of make us question if we've peaked when it comes to the heights of the dollar?
Well, certainly we have to question that. I think it's still unlikely that we've reached a peak yet. But that said, look, I think any dollar gains from here are going to be more of a grind than the sharp rally we've seen in recent months. A lot is in the price in terms of interest rate markets for Fed rate hikes. For example, a 75 basis point hike is more than priced at the July meeting for the Fed, and hikes more significantly thereafter as well. So I think with so much in the price, the dollar, I think, will find it more difficult to move higher. But that said, look, I think it's still a buy on dips. I think when you look at conversely what's happening with the euro, parity is still very much a magnet. The euro is still going to struggle to make much ground here. The ECB hiked at a time when Italy's government has fallen apart. Peripheral bond spreads are coming under pressure. And so, it's difficult to see how the euro can rally from here. And we talked about the weaker growth outlook as well. So it does still look like the dollar is the more favored currency.
So is the short yen trade obviously one of the hottest macro trades of the year? Is it looking overdone, or is there really nothing standing in the way, given that Governor Kuroda has said that they won't be targeting the yen?
Yeah, I think there's little to stand in the way here. It's hard to see dollar yen come off too significantly from these sort of levels, even though we've been approaching obviously 140. That could be a line in the sand. But again, we're not expecting intervention from the Bank of Japan, nor are we expecting to see any shift in the yield curve targeting, which they've pretty much said they're not going to do despite the moves in dollar yen. So if anything, the weakness in the yen is probably going to help reach the Bank of Japan's inflation target, and that gives them more support in that front. Now, clearly, there's a bit of backlash domestically for a weaker yen, but it really is hard to see dollar yen pull back too significantly from these levels, given, as I said, the fact that the dollar continues to be a bit of a buy on dips.
Mitul, we have seen significant resilience in the Chinese yuan, though. Where are we headed here when you're also hearing from Premier Li Keqiang that he might be a little bit more flexible with that 5.5% growth?
Well, that's right. Look, I think the yuan, certainly when you look on a trade-weighted basis, actually has rebounded. Dollar yuan has moved higher, but to less of an extent than other Asian currencies. So as you say, the yuan is somewhat resilient, and I think that will continue to be the case, although we do expect to see gradual depreciation against the dollar in the months ahead as China's current account worsens, and still given the fact that we're seeing limited capital inflows coming into China from foreign investors. So it still sees some weakness. But look, I think growth outlook is certainly under pressure. 5.5% looks very, very difficult to achieve. Our forecast is 3.8%. Now, we've had a bit of a rebound in June data, but with the housing market coming under more and more pressure in China, a lack of significant stimulus in the pipeline, it's really hard to see growth hit that 5.5% target.